Welcome to the ReluctantCapitalist.com's podcast. You're listening to The Clatch, better known as The Reluctant Capitalist, and the architect of the cone of profitability. With me, Pete Schuler. And now, here's The Clatch.
Good day, this is The Reluctant Capitalist, and today we are going to talk about beta and what beta is.
All right, Pete here. So let me start by saying that investors have poured billions into beta investment strategies. Obviously, it's best to understand the concepts behind any strategy before investing. Wouldn't you agree?
Yes, I
Clatch? So let's start by defining what beta is exactly and why it exists as an indicator in the market. So what can you tell us about that, Clatch?
Well, a stock's beta is intended to give a numeric value to how that stock performs against the S&P 500. And so if the S&P 500 goes up, this stock should go up also with the S&P 500 if it has a beta of 1.
And most experts use beta as a measure of risk. Isn't that true?
Often it's used for a measurement of risk in calculations like the weighted average cost of capital, the present value formula, the efficient market hypothesis, and the CAPM model.
Can we just say it's a measure of volatility?
Yeah, it's a measure of volatility, and it's expressed like this. You'll have a stock with a beta of 1.2. Cisco currently has a beta of 1.2. And the idea is that if the stock market moves up 1%, this stock with a beta of 1.2 will move up 1.2%.
Okay.
The stock market goes down 1%, the stock with a beta of 1.2 would go down 1.2%. And that's kind of what it's intended to reflect.
So in turn, a company that has a beta of 1.0 would mirror and match the stock performance of the S&P 500, correct?
That stock performance should match the S&P 500.
So let me just make sure I understand this. Say the S&P 500 moves up 2%. Cisco, having a beta of 1.2, would in theory move up 2.4%. Is that right?
That's correct.
Okay, and consequently, if the S&P index moved down 2%, Cisco, having the beta of 1.2, would in turn move down 2.4%.
Correct.
Okay, and that's the general reason why people look at beta.
Generally, yes.
So, Clatch, your findings actually contradict the beta theories. Is that true? And how can you explain that?
Well, the beta was produced, and Eugene Fama is a professor at the University of Chicago, a brilliant guy, came up with this formula. I'm pretty sure it was him. It was either him or he was part of the group that put it together.
What's his name again?
Eugene Fama, F-A-M-A. And it turns out it's a very elegant formula that really doesn't provide a good analysis of a stock. And there's some reasons why, and there's been many papers, white papers, and people arguing against it, saying it doesn't work, and they're not wrong, but I've never heard anybody explain why it doesn't work.
So, Clatch, Mr. Reluctant Capitalist, why is beta still being utilized as a benchmark for risk if, as you say, people who've written papers against it are not wrong?
Well, in a lot of financial calculations, the beta is used as a multiplier to reflect the cost of capital. And it ends up being very, very critical because it's a multiplier in those calculations. And so if the beta is wrong and you have a large beta and it's actually an irrelevant number, your forecasts are highly questionable. So there's reasons why it's wrong. And so if you look at beta as a correlation of the daily stock price change between a stock and the S&P 500, And that's essentially what it is. It's a little bit different calculation, but it's essentially a correlation coefficient. And so the correlation coefficient is between -1 and 1. -1 meaning they are inverse. An example of that is the price of a car and the miles on a car. The higher the miles, the lower the price in buying a car, and that's an inverse relationship. A positive relationship, or a perfect correlation of 1, is basically things that move together.
Sure.
The temperature in Southern California and the use of electricity.
Positive correlation.
Yeah.
Sure.
Well, I hate to bore you with statistics, but there's another measurement of a correlation, and it's called the R squared. And that is the number of observations that match up. And if you look at beta as that, you'll find a stock with a beta of 1, meaning it's like almost a perfect correlation, will have a R squared of 20%, meaning that one day a week, that stock matches up with the S&P 500. And the question you would have to ask yourself is, what is it doing the other 4 days a week?
Well, I guess then it wouldn't be matching up with the S&P 500 those 4 days of the week. Let me just ask you real quick, is there a place we can go to check this out, see for ourselves?
Yes, I put together a Google sheet that all you have to do is put in the stock symbol, and Google Finance pulls in all the data to compare a stock to the S&P 500, and it gives a scatter plot, the R squared, and the correlation. But it's worse than that. If the beta is a measurement of the price change correlation between the S&P 500 and stock, and then you correlate the stock price with the S&P 500, about 40% of the stocks out there will have a positive beta, but a negative correlation, meaning in the short term, it lines up, but over the long term, it goes the opposite direction. And it's like, how do you justify that in your financial calculation?
Well, that kind of blows my mind. I mean, you've basically taken the beta and almost disproved it. You mentioned Eugene Fama earlier. Let's talk about him.
In 2013, Eugene Fama won the Nobel Prize in Economics. And in his acceptance speech, he basically said, yes, this is a formula we used, and many people have worked to disprove it, and it really doesn't work that well.
On accepting his Nobel Prize for Economics, he admitted that it didn't really work?
In so many words, if you really listen to what he's saying, the guy talks at such a high level that I have trouble understanding him even sometimes what he really means. But I watched it a couple of times, and it's a whole hour acceptance lecture, and he basically says, yeah, it just doesn't work that well. I have a ton of respect for Eugene Fama. He's a brilliant guy. And one of the things we should recognize is simply that when he started putting this stuff together in the 1970s, data was not that easy to get a hold of. And one of the advantages we have now is data is overwhelmed. It's hard not to get a hold of it. I mean, everything is out there, especially in the stock market. We can test it in literally seconds, where it may have taken him 6 months.
And you have tested it.
I have tested it on all stocks that have a earnings per share. And so there's about 2,400 of them. And I found on average, the beta has a R squared of about 40%, meaning 2 days a week, the stocks line up with the S&P 500, and the rest of the time it doesn't. And about 35 to 40% of the stocks also have a negative price correlation, but a positive beta correlation. And so it tells you it's just a elegant formula that has no good usable results.
Wow. Does that mean that beta only works 40% of the time?
No, in average, all stocks, but when you're dealing with the stock market, stocks have very unique and individual characteristics, and you should look at them one at a time. But I would say if you're looking into investing, the last thing to consider is a stock's beta. It's completely irrelevant.
Well, Klatch, this is excellent information you're providing us. Is there anything else that we should know about beta that supports your findings?
Well, there's also some argument is of how long of a period you should measure. Should you use 3 months, 5 years, 3 years, 1 year? What is the proper amount of time? Because what happens is if you measure a stock's beta in 1 year, you may have come up with a beta of 0.8, and then you measure it for 5 years, and it's a beta of 1.3. So these things change all the time, and the length of time, the period you use, will influence the outcome.
Nobody really knows what's going on behind closed doors from any of these, stock companies either. But beta, that's kind of mind-boggling because it's so relied upon as an indicator of risk. And if you've proven, can I use that word?
Sure.
That this doesn't work very well.
Well, you should never prove something doesn't work. You should prove it works. And I cannot prove that this works. I see no mathematical reason to use it for what it's used for.
All right, well, there you have it from the Klatch. So listeners, I suggest that you check it out for yourself. Go to thereluctantcapitalist.com and you can Google it and it'll come up. Stick in your own companies that you want to test on the beta formula and see for yourself. I think you'll be positively enlightened and realize that this is really valuable information. So Klatch, we'd really like to thank you for providing us with your beta formula and with helping us make more informed and less reluctant decisions when investing in the jungle that is the stock market. So thanks very much, Klatch.
And thank you very much, Pete.
Again, if you'd like more information on beta and other subjects, please visit us at thereluctantcapitalist.com. Thank you for listening to the Reluctant Capitalist podcast. We'll see you again next time.